This is The Weekly on ClickOrlando.com with Justin Warmoth.
Good morning, I'm Justin Warmoth. Between economic uncertainty and booming interest rates, the once red-hot housing market is starting to cool off. Buying a home during the pandemic was more like the Wild West, fueled by low interest rates, low inventory, and high demand. So what's today's market snapshot, and where do things go from here? This morning, real estate consultant Kristin Mazza and mortgage lender Julia Bell are here to break it all down. Let's just talk about a general overview of the state of the housing market, if you would like to start, Kristin.
We've seen a huge change, obviously. We're coming out of one of the most aggressive markets that I've seen, doing this for 17 plus years. So I'd say that the shift has been coming, and we've been waiting for it, and it's here, and we're feeling it, we're seeing it. We're seeing it in increasing interest rates, obviously. And the inventory is increasing, which is a really good thing. So I'm finding a lot of positives happening, and I'm hopeful that we can talk a little bit about some of those.
Yeah, well, let's get into the positives. Obviously, nobody wants higher rates, but in a healthy market, let's just start there. Is this healthy? Is this a healthy correction to the housing market?
Absolutely. So just to put things into perspective, Freddie Mac in 1971 started producing data that said what interest rates would look like and what they were looking like. And the average rate is 7%. So we are in a very normal interest rate environment. What this does for our potential buyers is gives them the opportunity to have the upper hand. It'll be more competitive for them to be able to purchase a property at a more reasonable price. And although it's harder to qualify for financing because the rates are higher, it also puts them in a good position to possibly have sellers be a little bit more lenient on paying closing costs, prepaid items, etc.
And that was non-existent in the last 2 years, up until recently, right?
That's a good point.
It was sight unseen. If you had any sort of, hesitation, the seller was going to the next buyer, and cash was king as well. But you also had the low rates, so home prices naturally went up, and there was no inventory. I mean, they were getting snatched up like that, right? So, are we seeing the prices follow suit now that these homes have been on the market for a little bit of time, and it's starting to correct itself gradually? Are those prices starting to come down?
Prices are actually holding pretty well.
Okay.
We've had almost zero change from September to October. Going back from a year, we're actually up 12% in valuation. So another positive.
Right.
So we're pulling from a very aggressive time, as I mentioned. So, appraisers look back 3 months, 6 months, up to a year if they have to. So the people who are doing the evaluations right now are still really picking from some nice numbers. So the values are holding. Will that continue through the holidays? I don't have that crystal ball to tell you that, but I would tell you that right now, values are holding.
Values are holding. So while that is good if you would like to sell, for someone who would like to buy, you have this home at a price, and you have these rates that are now higher. So naturally, your monthly payment obviously goes up. Let's talk about that for perspective on, let's just say, listen, I'm not a math guy, but I imagine that it's hundreds of dollars more per month on a monthly scale when someone has their rate essentially, let's just say, double. And if they would have bought, let's just say in 2021, at a home at the same price now, but today, those monthly payments are more.
Oh yes, so the average loan amount in Orange and Seminole County, just to put it into perspective, is about $350,000. With a 3.5% interest rate, the principal and interest payment would be roughly $1,572. With a 7.2% interest rate, which is our bank national average today, you're looking at about $2,376. So that's about an $800 difference, Justin.
Yeah, and that makes or breaks. I know a lot of people with their budgets. Listen, maybe I was in the market for a $400,000 house or a $350,000 house. That is no longer the case.
Yep. One thing to add to that, though, that's a great numbers to have, but looking back even a year ago, let's just say you had your house listed for $400,000. It may very well have sold for $450,000, $465,000, $475,000. So I've seen these scenarios drawn out because this is what we do all day, and I love these numbers and stats. So really, the increase in the valuations from last year really kind of, I don't want to say they're a wash, but you've got to take all of those things into consideration. So a $400,000 house that really sold for $475,000 last year may be selling now for $385,000. $375,000. So that delta between what it would have sold for in 2021 down to 2022, it's proportionate.
It's not necessarily the listing. Like, yes, the listing prices may have been moving slightly, maybe stalled, as you said.
Sure.
Basically,
kind of flat.
Plateau, flat. But people are paying way over listing.
Yeah.
And that's a great point to make, is that it's a completely different market. So let's start with a home buyer. What should they be looking for? Obviously, they don't have a crystal ball, and like you pointed out, we don't know what prices are going to do. We don't know what rates are going to do. But what would you tell someone who is insistent in saying, listen, I want to buy today in the Orlando market? What's the advice there from you?
Advice from me, number one, is align yourself with professionals who have been through this before. So being in this business for a long time, I've seen the market do this.
Cyclical, right?
It's cyclical, like everything else in life.
Right.
So what goes up is going to come back down. And sometimes it's this. Right now we saw a little bit of this. So if you're not aligned with someone who knows what they're doing, you're really putting yourself at a disadvantage. And that includes the mortgage piece. I know Julia's been around doing this as long or longer than I have.
22 years.
And it's just really important to put yourself with people who know the programs that are out there. And there's a really new exciting program that Julia and I were just talking about regarding, it's called like a 2-1 buy down or 3-2-1 buy down. There's all different structures there. And I'm excited to hear you tell a little bit about that, because I think it's going to put buyers into properties that they may have otherwise, I'm not really comfortable with that rate right now.
Sure.
But as their position changes and as they get increases in their salary, things like that, good things are going to happen. Who knows where the economy is going to go. But, I just think those programs are going to be really important to some buyers who will get into homes because of it.
So you said a few minutes ago, you said what goes up must come down. And so what I will say with this buy down is it is a temporary fix so that later the buyers today can refinance, but we can still get them in at a lower interest rate.
Right.
So to put it into perspective, 7.2 is the national average, as I had mentioned today. With a buy down, depending if it's a 3-2-1 or a 2-1 buy down, it's bought down 3% lower than today's going rate of 7.2, or 2% lower if it's 7.2 to the 2-1 buy down. The cost to the consumer or the seller is minimal to see the difference in an interest rate of about $800 a month in a monthly payment.
Right.
So a buy down is a great alternative program that can be offered so that somebody who is rate sensitive today can get into a home and refinance it later.
I see.
Yes.
What are the qualifications there?
So that's a great question, because they do have to qualify off of today's note rate. So if the rate's 7.2, they're not going to qualify at the buy down interest rate. They're going to qualify with today's interest rate of 7.2.
Right.
Okay.
Yes.
But it's kind of a way to ease into an interest rate over time, if I understand that correctly.
Absolutely.
And I think it's a great idea too, because it allows the seller now to be able to, or they're going to be asked to now, give some concessions that, again, a year ago didn't exist because they had 11 offers on the table. And if somebody was asking for closing cost help, they'd be like, next. So
you couldn't even utter those words.
Yeah. So I just think it's giving a little more leverage to the buyers out there, and it's going to cost the sellers less than a price reduction.
We'll have more insight on the market coming up, including why this situation is completely different from the housing market crash of 2008, especially in Florida. Stay with us.
This is The Weekly on ClickOrlando.com with Justin Warmoth.
Welcome back as we continue our discussion on the state of the housing market. The process to buy and sell a home changing drastically in the last 12 months, but what hasn't changed all that much, listing prices. After they spiked during the pandemic, some feared that home values would eventually fall off a cliff.
Real estate consultant Kristin Mazza and mortgage lender Julia Bell are back with us to explain why you can't compare today's situation to what happened in 2008.
Historically speaking, I mean, we've talked about both of your experience, and a lot of people like to draw down comparisons. And obviously, everyone talks about the housing market collapse of 2008, 2009, what have you, and what we went through there. I just want to clear up that this is a completely different scenario, A. And B, for the folks who think that they're still under the belief that the housing market will crash, can we talk about that and from the mortgage side of it, and what you're seeing and the differences there as well?
Sure. So in 2008, there were a lot of irresponsible lenders that were lending to people that truly could not afford to be in a home. And today, that is not the case. Lenders are very careful to make sure that someone is truly qualified from a debt to income standpoint to a credit worthiness, et cetera. So that alone puts it very different than before. What I would say is that 8.9 million Americans moved during the pandemic. 28% of them were in Florida.
I was going to say a whole lot moved here. I can attest. Yes.
So with that being said, people are still going to move. Everybody has to have somewhere to live. And Florida is in the top 10 of places to live in the United States. So people are going to still move here. And we're just going to have to be a little bit more creative with the opportunities. And higher interest rates are not going to deter people from moving.
I think everyone has become accustomed to the refi, which we've talked about, the whole refinance situation, and a lot of people took advantage of those low rates and refinanced their homes during the pandemic. It's a process. I've not done it, but I know that it's not as easy as it sounds. There's a lot to it. It's like you're buying a home again. So that whole, that's an option. As we talk about the different markets, because you made a good point, Florida is still a destination folks want to live. And so the other markets perhaps will come down seemingly maybe a little faster, more of a drop off, the Boise, Idahos of the world, which did become pandemic havens. A lot of people wanted to move there, and they saw their housing market go crazy.
You're right.
But in a state like Florida, in a city like Orlando, in the greater Orlando area, that is more of a gradual adjustment, right? I mean, that's what you're seeing.
Yeah, definitely. Even during the crash of 2008, we were here for that too. It was definitely a time of just turmoil, like so many foreclosures. We're not seeing that right now. We're just not. The distressed properties are just not out there. You may, as we do searches for buyers, we have a lot of investor buyers who want to buy a good deal. This may not be that market right now. Because of the evaluations, because the values are pretty high right now. But during 2008 and 2009, it was chaos. And right now, I just feel like we've had a slow, gradual sort of change and a shift, but I don't feel like there's that panic out there that we saw then.
It shifted, but not crashed.
Yeah, that's a difference.
Yeah.
Right. It was almost healthy because the current market was not sustainable. I mean, obviously. But I'm curious how obviously you treat your job, it reflects the market. And so the way that you go about how you sell a home or how you help someone buy a home, that changes. And so how has it differed in the last 2 years, and what have you been seeing recently? Are you going back to your roots?
Right, yeah, we really have to go. Thanks for bringing that up. Yes, we do have to go back to our roots and really kind of get back to what we did in the beginning when we first, got into this business. What would you do to make yourself successful? We dropped by places. We would call clients every single day. We would send out handwritten notes every day. All of the things that we did back then, we didn't have time to do that in the last 2 years, quite honestly. We try to do our very best every day for our clients, and I think we did that. But it's a definite shift in how we have to conduct our business to even get buyers kind of off the fence and educate them about what kind of products we have and what kind of team and affiliates we have that we work with that can really, I think, kind of ease some of their fears. Another funny thing about new construction is what we're seeing a lot of changes in too, because I was telling a story the other day about I had a family member who was looking to build a home. And so we would look at these new communities, and they would barely put a sign out there that said, coming soon, new community. And they would have like 60 or 70 people on an interest list within the first weekend. You literally could not even, they didn't even have a trailer up there yet, nothing. And they were selling out. Now, and we were like sending them cookies and gift baskets, and so just in case I bring you a client, please remember I was the girl with the cookies.
That's right.
Well, guess what? Now we're getting cookies. So they want us, they know we're working with qualified buyers, and now they want us now to also now consider, and with, supply chain shortages, it's been tough. You could be building a house for 18 months or more. So it's just funny, that shift there for me has been one of the largest and most noticeable.
Very interesting. I don't like using it. It's a dirty word, dirty R, recession. And listen, you're depending on who you ask, we're in one, we've been in one, or we're going to get to one. Doesn't matter. If it is when it is said that we are currently in a recession, how will that impact rates? Obviously, the Fed will react in a certain way, but then that trickles down to rates, mortgage rates. So, is that something that you've thought about, and how will you attack that when that happens? What do you expect to see?
So everybody has to have somewhere to live.
Yeah.
They're either going to rent or they're going to buy.
Yeah.
So in 1980, the prime rate went to 20%. And that drove interest rates to a whopping 18.63%. Today, recession is it's hovering around 8.3%. So what the feds are trying to do is to pressure that, stop it from increasing by increasing the prime rate. So it's cyclical. It's, history repeats itself, and once again it is. So I truly believe that circumventing interest rate by letting people know that buying a home is always a solid investment is the best way to approach it. Because it is. There's nothing in the world that is better, that can build you more wealth than owning a home. So it's just setting them up for financial success long term.
I do want to bring this up because I meant to do it earlier, but what this current market is doing to first-time home buyers. It's tough, and it's always tough to buy your first home, and I think that's certainly the case in today's society. But the factors now at play for them, it's just they have to have a lot of liquidity and a great credit score, obviously, but that's how you buy a home. But what is this doing? Is this pricing a lot of folks out of the market?
If it's not pricing them out of the market, it's at least making them have the conversation with their real estate professional as to what should we be searching for now. In other words, we wanted the 4-bedroom with a pool, and we wanted an indicated community, and they may not be able to get all of those boxes checked anymore, but they still can achieve that dream of home ownership. It just may shift a little bit into, a little bit different package, but there's going to be more inventory coming on the market, which has been a blessing because as we know, it was tough to even find homes for new home, first-time home buyers.
Sure.
So I think this has been healthy. I really, honestly, I think long-term it's gonna be a really good benefit.
And my thanks to both Kristin and Julia for their time this week. For more information on the housing market and the possibility of rates going even higher, just head to clickorlando.com/weekly. I'm Justin Warmoth. Hope you have a great Sunday.